So a qualified mortgage, CFPB has designated what's considered a qualified mortgage. This is a special class of mortgages. And what these mortgages are is that mortgages that the lender will provide, that they have certified, that they've checked to make sure that the borrower actually has the ability to repay the mortgage. Okay? So if the lender has gone through the steps that the CFP has put together to say this is now a qualified mortgage, and we're going to go through what those steps are, and the lender issues that qualified mortgage, which means they've gone through the steps to make sure that the borrower actually has the ability to repay the mortgage, then if they ever get in trouble, then the lender, the Federal Reserve, the government will back them up. We'll give them bailout money. We'll do whatever they need to do. They have a safe harbor because they took an extra step to make sure that the mortgage is considered a qualified mortgage. You'll hear the term ability to repay. Ability to repay, ATR. Write that somewhere. Ability to repay equals ATR. Ability to repay. So if a lender issues what's called a qualified mortgage, that means that the creditor went through the ability to repay steps, and they actually made sure the borrower has the ability to repay. So what that means is, it can't be stated, it can't be no doc, it can't be anything. They actually looked at their income, their expenses, all these different things that we're going to go over, and they determined that the borrower actually can repay the mortgage. It wasn't a stated doc, it wasn't a no doc, it wasn't any of those things that got the mortgages in trouble before. Must meet minimum requirements prohibiting and limiting risky features. So a qualified mortgage wouldn't be an interest-only loan or a pick-a-pay or any of those fancy things that we had in the last few years. The new laws provides an incentive to lenders. If the lender issues what's called a qualified mortgage, they have what's called a safe harbor. If you get into trouble, if this borrower comes back and sue you later, don't worry, we have your back because you took the extra steps to make sure that you issued a qualified mortgage. So if anything ever goes wrong with this mortgage, we'll bail you out. We have your back. You have a safe harbor with us because you took those steps. These are the steps. These are the characteristics of what's considered a qualified mortgage. And you need to know each of these, so I have a lot of it in red. So a qualified mortgage, they're going to ask you questions. Is the following a qualified mortgage or not? Or which of the following is a qualified mortgage, which of the following is not? You need to know a qualified mortgage will never be a no-doc or a NINA. No-doc loans, NINA loans are not qualified mortgages. You need to know that the maximum back-end debt-to-income ratio on a qualified mortgage is 43%. We're going to learn how to calculate ratios. If it's over 43%, it's not considered a qualified mortgage. The most points that can be charged on a qualified mortgage is 3%. 3 points. Whether it's on the front, whether it's on the back, however you get it from the lender bar, the maximum fees that can be charged on a qualified mortgage is 3 points. Any loan that's over 30 years is not a qualified mortgage. So 40-year, 50-year loan, they're still doing all of those, but it's not in this category. You have to know what's considered in the category of a qualified mortgage. So if it's a 30-year loan or 40-year loan, maybe better for the borrower, but it's not considered a qualified mortgage. Interest-only loans are not allowed. Negative AM loans are not allowed. They're getting back, if you really think about it, a qualified mortgage is a normal, everyday, 30-year fix. They want to get back to what it was before. So if it's interest-only, it's not a qualified mortgage. If it's negative AM, it's not a qualified mortgage. If it has a teaser rate, we're going to start at this and you're going to adjust to this, not a qualified mortgage. Again, the best way for me to describe a qualified mortgage, 30-year fix, back to where we were before, where they've actually looked at your income, your expenses, everything, to qualify you, full doc, okay? A qualified mortgage, if it isn't adjustable, they have to make your payments based on whatever your highest payment will be in the first 5 years. Because say if it adjusts every year, they can't qualify you on what is going to be year 1 or year 2. They have to qualify you based on what it's going to be in year 5. Also, there are no prepayment penalties allowed in a qualified mortgage. So all of those things in red was what make a mortgage a qualified mortgage. Now they'll be issued, and I get emails all the time, we offer non-qualified mortgages. Doesn't mean the non-qualified is a bad mortgage, because that's where you get your interest-only loan. That's where you get your 40 years. That's where you get all your things that some of you can still go stated. But they're not going to have the safe harbor, the legal protection on those mortgages that they would a qualified mortgages. So banks issue qualified mortgages and non-qualified mortgages. People think if it's non-qualified it's a bad mortgage. No, it's just you didn't have to show this or you didn't have to show that. Qualified mortgages are safer for the bank if they